Hi, this is CF Liu here. Now, it really saddens me to see situation like when a parent buy a so-called savings plan, insurance savings plan, for their kids, or when people who are about to retire and they want to buy some savings plan and end up something like this. They expect to get some amount, but they end up not getting that amount as what they understood previously, maybe 10, 20 years ago. So what is exactly the problem here? Is it because the insurance company is cheating these people or cheating you and me? No. If it's really cheating, they won't be in business, and we could actually sue them and bring them to court. Now the problem is there are a few types of policy, of insurance policy, and the owners actually all falls to us or you as a consumer to get the right kind of thing, policies or whatnot, or savings plan for yourself. And in this video, I'm going to show you what are the type. If you really want to get one, what are the type of things that you want to get, and avoid the types of thing that really would will end you up in a situation or unfavorable situation like this. So first of all, you have what we call as a type 1 of a policy. Okay, what is type 1? Now you can see that type 1 of policy, you might, for example, this is what imagine you want to buy for your kids or whatnot, 5 years old, and someone come to you and they say, oh, for a premium of 15,000 per year. Okay, 15,000 per year, and they tell you that, oh, you pay for 15 years, so that is you will be totaling paying about 200,000. By the end of the 15 year, you will get a lump sum of money back in your bank account, which you can use for your children education fund. Right? Now, the other thing is that, this kind of policy is not only have this kind of surrender value after 15 years that you can get back, but also in the interim, if anything happens, then you will get a payout, a guaranteed payout of 900,000. So you only pay 15,000 per year. You get an insurance coverage if you die or disabled and all that, about 900,000, plus a certain amount surrender value at 15 years. So what is the surrender value we are talking about over here? So with that being said, need to actually scroll this down and see. This is the exact table that we will be looking at. Okay, and this is regardless of any insurance company, right? I mean, if you do not know what you're getting into, some people thought some insurance company are bad or whatnot, but it's actually not the insurance company. It is the type of insurance policy, because there are multiple types of insurance policy. So we are still talking about type 1 of insurance policy. So what it means is that 15,000 per year for 15 years, so you will end up paying about 200,000, right? 200,000 by 15 years. And then at that point of time, when you want to actually take out the money, they will tell you that, oh, at the end of the 15 year, which is over here, and then this over here, you trace it over here, they say that, oh, you will get back 317,000. All right, 317,000. So sounds good, because you only pay like 200,000, but you get back 317,000. Now the thing is, you have to look at this table and see that this is what we call as non-guarantee. You get me? Non-guarantee. So this kind of whatever surrender value that is illustrated over here is actually non-guarantee. And there is what we call scenario X, Y and X. So this is what we call as very pessimistic. I mean, what is the worst scenario that can happen? And this is a projection of the optimistic scenario that can happen. But still, it is not a guarantee that any of these figure will apply. No. This figure, everything of this figure is just a projection. Even though they have like, okay, worst case scenario is by 15 years you get this amount, but in reality, can it be worse than this? Yes, it can. But when this kind of policy are being sold to you, they will almost never, any agent would almost never tell you about what is the worst case scenario. But if it's worst case scenario, then you are basically saying that you pay 200,000, but you will be expected at the worst case scenario getting back 193,000, which is almost break even. But again, it is non-guarantee. Non-guarantee. This is the word non-guarantee. They will always show you or sell you based on this value, which makes it looks good. So end of 15 year, if let's say you get like maybe just 210,000, but because the agent, maybe the friend, a colleague, an ex-colleague, and whatnot, sold you on the pretext that they sound like it being sold to you sound like you're getting 300 over 1,000, and you are not getting that, and you say, hey, I'm supposed to get this, but I'm only getting this. So what's the problem here, right? And can you actually sue or what is sue or cari pasal with the insurance company? The thing is not, because in the policy itself from day one, you do not know, and probably if your agent is a relative and whatnot, I doubt that he's trying to blindside or cheat you. But the thing is probably the way he sold is what is being taught by the agency itself. So he or she doesn't even know at the point of when he sell this policy to you, he or she doesn't even know how to interpret this table. What he only knows is that just take this figure and sell this, right? So this is the problem here. So you are buying a type 1 of policy. And the other problem that I want to show you is this, right? This is the other problem, which is even worse. Now, this is what we call as the type 2 policy. Now, let me just change my color to this. So, this is what we call as type 2, okay? Type 2 of policy. Maybe this is a bad idea. Okay, I just write it here. Type 2. Now, type 2 policy, it's even worse. Okay, what I mean by that. Okay, just write here. Type 2, okay? This one is type 2 policy. Okay, type 2 policy is even worse because as you see, this is another table, all right? This is another table that you want to look at. Okay, now this sounds better. This looks better. Now, you see that there is also a surrender value. Now, this seems to look better because you have something called a guarantee value and a non-guarantee value. So again, this policy, of course, when it comes to death benefits, okay, it's always guaranteed. Type 1 policy, you have your guarantee death and disability benefit of 900,000. Now, what I want to show you is what if you don't die and you don't get disabled by then, what are the amount that you can recover back from this policy? Because that is exactly the case. You want some savings plan and whatnot. You want to know what are the guarantee amount, exact amount that you can guarantee to get back. If by the duration of the policy or whatever amount, 15, 20 years, you don't die, you don't disable, so this death benefit is actually non-applicable, right? So the death benefits and all that, the coverage amount is always guaranteed. But as you know, in the type 1, nothing is guaranteed. But in type 2, it seems like there's a portion of it is guaranteed, but there's a portion of it is non-guaranteed. But I tell you why type 2 is even worse, because it's super expensive. Just now, we are paying about, in type 1, we are paying about 15,000 a year, right? 15,000 a year. To get 500,000 of so-called insurance, and we only pay for 15 years, right? 15 years, and then by the end of 15 years, we would have paid like 200,000. So 200,000, and then you will end up getting a projected amount of, pessimistic condition of 200,000 non-guaranteed. But this looks like better, because for this amount, you have like 600 over 1,000 of insurance. But if you look at the table again, what happened by 15 years over here? So over here, you can see that this kind of policy, type 2 policy, are super expensive. Okay, avoid this at all costs. Even you can afford to so-called save or pay 53,000 per year just for the savings, and end of the 15 year you would have paid 700,000. So what happened at 15 year is that along the way you have these death benefits like I've shown you over here, but the other thing is, what is only guaranteed at the end of 50 years is only 300,000. You see this? The non-guaranteed portion, again, you have X and Y scenario, which is one is what we call as a pessimistic scenario, one is optimistic scenario. And even if you were to add these two together, this would come about total of about 450,000 ish compared to what you have paid, like 742. So if I were only to take the guarantee value, now imagine who in the right mind would actually pay 742,000 in total for 15 years, and then it's only 300,000, less than half of that amount is guaranteed. Then you say, wow, what kind of so-called savings plan or insurance product is this? Now, I can tell you this kind of product still exists, and this is a quotation I generated from my insurance company. Don't want to name who, that's why I black out all the names. But yes, this kind of product still exists, and I don't know how these are still being sold. But if you look at, regardless of whoever approach you, the agent, your friend or relative approach you, and he paint all the nice picture in the sky, do a table for you, but the only thing that holds water, the only thing that is concrete is you look at the quotation. Not something Excel sheet that you do for you, but look at the actual quotation, like something like I'm showing over here. The actual quotation will not lie, because these are all regulated by the central bank. So you have something of guarantee value, non-guarantee value, and if you look at this, it just doesn't make sense. But yes, this kind of product still exists. So, and sometimes when people get into this kind of product, is because they trust their family, they trust their ex-colleague, which have no intention of cheating them. But the thing is, the one selling this kind of product or savings plan, they don't even know what is this about or how to read this table, and just regurgitate what is being trained, how they are being trained to sell this kind of policy. Okay, so this kind of so-called policy, as you can see over here, they have a disclaimer, right? This disclaimer always says that, okay, maturity period X and Y. So it says that what are the historical return, blah blah blah, but X and Y, the pessimistic scenario, we say that assumption is 2% per year, where optimistic is about 5% per year. But again, who knows what will happen in the next 15 years. So this kind of, I would say, type 2 policy, you must avoid at all costs. Okay, so the third type of policy that I want to tell you about is this, and this is the one that not a lot of insurance company have, but it gives you certainty. Okay, there's no uncertainty, absolutely certain. There's no things like non-guarantee and all that, as you can see over here. Now, this is a table of the product, what we call as I would want to name it type 3. So imagine someone who are 35 years old, alright, starting from here, and you want to say that, hey, what if I want to get $500,000 of coverage? This is a certainty that I'm talking about, $500,000 coverage from now, say, until the 15 years. So basically, you don't need to pay this policy until 100 years old, but you just cut off at here, alright? So this is 15 years. And this is so-called compressed paying premium paying policy, and what it means, like 15,000 or 14,900 per year, and this one is only paid for 10 years. So you would have paid 150,000 in 10 years. Okay, in 10 years. So throughout the time you have $500,000, but you can see that if you need it for 15 years, and by 15 years you want to surrender it, the surrender amount over here is 163. You see that? And you have only paid about 150,000. But you would actually more than break even 163. And you can see this table over here. Everything here is guarantee. When everything is guaranteed, an insurance company cannot say I do not honor this amount. Okay, this amount, the surrender value amount over here. So you can see what if you hold until like, of course if you hold like longer, then this will be the guarantee amount. But I'm just comparing. Let's say you need it for 15 years, for the next 15 years before you so-called cash out. So you cancel that. Throughout now to 15 years, you have $500,000 coverage, which is good. But if anything does not happen, you don't die and things like that, you want to actually cash out, you still have 163,000 compared to 150,000 that you have paid. And this amount, again, I have to stress, is guarantee because it's stated over here. So this is the type of type 3 is the type of policy that you want to get. If you want to get, you know, kind of like coverage and also the so-called guaranteed surrender value. So again, to recap over here, type 2 is bad because surrender value, there's a non-guarantee portion. Type 1 is also very bad because everything that is highlighted over here is non-guarantee. So when it comes to insurance company, because the insurance policy, all we want is certainty, and the certainty that we want is everything has, when it comes to death on disability and all that, and we want a certain surrender value, it has to be here, it has to be guaranteed. Okay, it has to be guaranteed. What I've shown you over here. So that being said, this is CF Liu, and hope this is useful. And you might want to continue to the next lesson. If you like this lesson and you find it very useful, give it a like, comments below, and hit the notification bell, subscribe to CF Liu channel, and I will actually see you in the next lesson.